The year 2008 is etched into modern history. It was the year the global economy hit a wall, triggering a market crash, the Great Recession, and a crisis that permanently changed how we view finance. It stripped millions of people of their homes, jobs, and retirement savings. But 12 years later, many still struggle to understand what actually caused this financial earthquake. Was it one bad bank, one faulty product, or a decade of escalating risk? Today, we are breaking down the three primary causes, the week the world nearly ended, and most importantly, the likelihood of it happening all over again. The 2008 crisis wasn't a meteor strike. It was a bubble that burst, and that bubble was the U.S. housing market. The entire collapse can be traced back to three interconnected root causes that created a perfect storm of systemic risk. Cause one, the subprime mortgage bubble. The fuel for the fire was a massive expansion of lending to what were called subprime borrowers. These were people with lower credit scores or those who historically couldn't afford a traditional mortgage. Banks and mortgage brokers, hungry for profit during the time of low interest rates, offered highly risky loans, often with adjustable rates that started low, called teaser rates, and then ballooned after a few years. They did this under the dangerous assumption that U.S. housing prices would always go up. Cause two, toxic financial innovation, securitization. This is where it gets complicated, but it's the core mechanism of the crisis. Once a bank issued thousands of these risky mortgages, they didn't hold on to them. Instead, they packaged them up with safer, prime mortgages into complex financial products called mortgage-backed securities, or MBSs. These MBSs were then sliced up into different tranches, rated by credit rating agencies like Moody and S&P. Since the top layers held the lowest perceived risk, the rating agencies stamped them with coveted AAA ratings. But here's the terrifying part. Banks used these highly rated MBSs to create even more complex derivatives, specifically collateralized debt obligations, or CDOs. These derivatives were essentially pools of multiple MBSs. The result? A colossal network of financial products based on highly toxic, low-quality underlying debt. Cause three, the shadow banking system and leverage. The third critical cause was the lack of regulation across a vast segment of the financial world known as the shadow banking system. This included huge investment banks like Lehman Brothers and insurance giants like AIG, which weren't regulated like traditional commercial banks. They piled on massive amounts of debt, a process called leverage, to buy up these high-yielding CDOs. Lehman Brothers, for instance, had a debt-to-equity ratio that allowed them to control over 30 times more money than they actually had in capital. When housing prices finally peaked in 2006 and started falling, the subprime borrowers couldn't afford the new, higher payments. Defaults skyrocketed, foreclosures surged, and the value of those AAA-rated MBSs and CDOs dropped to zero almost overnight. The entire financial system was built on a foundation of sand, and the tide was going out.
The crisis didn't happen in a single day. It was a slow-motion car crash that accelerated sharply in 2008. Early warning signs, 2007. By early 2007, subprime lenders began going bankrupt. The first major institutional sign of trouble came in July 2007, when two major hedge funds run by Bear Stearns, one of the oldest investment banks, collapsed because they were heavily invested in those now worthless mortgage securities. The market knew something was wrong, but few grasped the scale. The first major bank failure, March 2008. In March 2008, Bear Stearns itself, having exhausted its cash reserves, was forced into a fire sale, acquired by J.P. Morgan Chase for mere pennies on the dollar, a deal backed by the Federal Reserve. This was a clear signal that the financial system was deeply, perhaps fatally, compromised. Black September, September 2008. The real climax came in September 2008. September 7th, The U.S. government nationalized the two massive mortgage finance companies, Fannie Mae and Freddie Mac, which backed about half of all U.S. mortgages. September 15th, Lehman Brothers. This is the day the financial world stood still. After the government decided not to bail it out, the 158-year-old investment bank Lehman Brothers filed for bankruptcy. It was the largest bankruptcy filing in U.S. history. This created an immediate, freezing panic because it proved that no firm was too big to fail after all. The contagion, the bankruptcy of Lehman Brothers, immediately jeopardized the global insurer, AIG, which had sold massive amounts of insurance called credit default swaps, or CDSs, on those failing CDOs. AIG didn't have the cash to pay out. If AIG failed, it would have defaulted on promises to banks all over the world, destroying the credit system entirely. The U.S. government stepped in with an $85 billion bailout, essentially preventing a global financial collapse. This, alongside the passage of the Troubled Asset Relief Program, or TARP, which injected hundreds of billions into distressed banks, was the emergency medicine that stopped the bleeding. But the damage was done. Stock markets crashed worldwide, credit froze, and the Great Recession began. Since 2008, sweeping reforms have been implemented primarily through the Dodd-Frank Act in the U.S., designed to prevent history from repeating itself. The good news: stronger banks. Today, the core banking system is much safer. Banks are required to hold significantly more capital, known as capital requirements, as a buffer against losses. Regulators perform annual stress tests to ensure banks can survive another economic meltdown. And crucial elements of the shadow banking system, including derivative trading, are now far more transparent. The crisis of 2008, the one caused by subprime mortgages and hidden CDOs, is highly unlikely to recur in the same way. The new risks. Where is the next bubble? However, the financial system always finds new ways to create risk. The nature of the threat has simply shifted. Firstly, we have seen a massive rise in government and corporate debt globally. While household debt is slightly safer, overall public and corporate debt is at historic highs, leaving less room to maneuver in a crisis. Secondly, non-bank financial institutions are still a concern. While commercial banks are regulated, the shadow banking system has continued to grow, shifting risk to lesser regulated players like fintech companies and private equity funds. Thirdly, risks now emerge from non-traditional sources. Things like geopolitical instability, the effects of climate change on asset values, and even instability caused by cryptocurrency markets or complex trading algorithms. The consensus among economists is that a crisis of the magnitude of 2008 is less likely due to regulatory safeguards. But history tells us that bubbles always form where regulations are weakest. The next crisis probably won't be about houses, but it will certainly be about excessive leverage in an opaque corner of the market. Staying vigilant and demanding transparency remains the best defense.